Good afternoon and welcome to Tallink's Investor Conference webinar. Today we are hosted by the member of the Management Board, Harri Hanschmidt, and the Financial Director, Veiko Haavapuu, who will introduce the financial results and company's activities of the first quarter of 2019. Right after the presentation, we will open the floor for questions. If you would like to use the opportunity to ask questions from Veiko and Harri, please use the question box on the right side of the screen. All questions will be answered after the presentation. Harri and Veiko, I invite you to start the presentation.
Yes, hello from our side. My name is Harri Hanschmidt. I'm the board member for the Tallink Group. Thank you very much for taking your time and showing interest in our company. We have a new investor strategy in place, and this means we are doing some additional activities. First of all, we are doing quarterly webinars, and this is the first time we do a webinar. We also have 2 roadshows each year, where at least one management board member will be present as well. We want to be an open and investor-friendly company, and therefore we have also done a dual listing on our main market. That is, we are listed in Helsinki, and we have a new dividend policy in place. So first, maybe I will go over where we right now are and then what we do. So Tallink is the leading European provider of leisure and business travel and sea transportation services, and we operate in the Baltic Sea region. We own a fleet of 14 vessels, and we operate on 7 ferry routes. We also operate 4 hotels, 3 in Tallinn, 1 in Riga. Our revenues for the 2018 financial year were 950 million euros with a 1.6 billion asset base, and this is mainly the vessels. We have over 7,000 employees, and we serve over 9.8 million passengers annually. Our Club One loyalty program has 2.5 million loyal customers, and we also transport 385,000 cargo units annually. We have strong brands, the Tallink and Silja line brand. Today's webinar main goal is to talk about the Q1 highlights and key facts, and I will get started right here. In Q1, and this is our low season, we have a reduced number of departures due to 7 vessels being in dockings, so out of the operations. We also did increased level of investment. In addition to the docking of the vessels, we did a service design upgrades on the public areas on most of those vessels, and we did interior upgrades. We introduced new concepts. We upgraded the public areas, also upgraded the cabins on various vessels. We are happy to say that we have signed the shipbuilding contract to build a new LNG-powered shuttle ferry for the Tallinn-Helsinki route, together with the Rauma Marine Construction shipyard. And this vessel is expected to be on operations in 2022, beginning of. We had changes in the management board, but the new management board is in place now, and we have done a fuel hedge in mid-December, and about 41% of the fuel we consume is fixed for the 2019 financial year. And there has been also a change in the reporting standards. We have effect from IFRS 16 adoption on our financial statements, and our financial director Veiko Haavapuu will elaborate more on this. Yes, and we also have the Q1 results here, and these were then affected by less trips. We can see that the passenger numbers dropped by 3.9% and resulted in 1.855 passengers. We had a positive increase in the same time in cargo units, and the number of passenger cars was down by 3.7%. The revenue was down 2.9%, and the EBITDA was down by 9.5%, but here is the IFRS effect as well, so the EBITDA actually was on adjusted level lower than last year, but this is explained by having less trips and less ships in the operation. There were also one-off effects, non-recurring costs from the compensations paid to the resigned management board members. On slide 6, we can see the quarterly seasonality breakdown, and the first quarter is our low season, so we see less passengers, 1.9 million, the cargo units were 93,000 units, so this is the best result in the past years. The revenue was 179 million euros, and the EBITDA, we already said, 4 million euros. And therefore, to those dockings and upgrades, and this is typical to our business model. In the first quarter, we made 25 million of a negative profit. But here I would like to remind you that we are in a very good shape now, having done those upgrades, and I hope we have very good quarters in front of us as the summer high season is starting, and then the second quarter always has been a much stronger quarter. I will give the word now to Veiko Haavapuu, our financial director, and he will continue with the presentation.
Hello, my name is Veiko Haavapuu, and I will go into more details in our results. And here you see the breakdown of the operational segments. So the total revenue was down by 5.3 million euros, 2.9%, and amounted to 178.9 million euros. So the restaurant and shop sales on board ships and on shore was affected most of all by 1.5% less trips in the Q1, but also as there is lower revenue from accommodation sales, there is also lower revenue from the restaurant and bar sales from hotels. And in addition to that, there is also slightly lower revenue from the land shops. Ticket sales is 3.0 million euros lower compared to last year. Of course, this is impacted also by the lower number of trips, but also there is higher competition in some of the routes, so which has strong pressure on the ticket prices. Cargo transportation slightly up from last year. So the volumes are slightly up and also the revenue slightly up. So we have very good performance considering the lower number of trips. Accommodation sales 1 million down from last year. This is mostly from the absence of one hotel, as Pirita Spa Hotel was sold by its owner last year. So we have one hotel less in operations, but also there is some impact from the renovations of the Spa and Express Hotel in Q1. So the revenue by the geographical segments. So the geographical segments, first of all, to comment on the shipping operations. So the shipping operations revenue is down 3% from 3 million or 1.8% from last year. And again, here I make a reference to the 1.5% lower number of trips. And going into more detail into specific geographical segments. So Estonia, Finland, the total market decline in the Q1 was 4%, and Tallink's volume were down by 3%. But here is also impact from the shuttle vessel star docking, which lasted for 14 days in Q1. Estonia, Sweden. On Estonia, Sweden segment, there were 2 vessels out in the dockings. So Baltic Queen for 42 days and Victoria for 14 days. So therefore, this drop in the revenue is expected. Latvia, Sweden, comparable to the last year levels, although also in Latvia, Sweden route, the cruise ferry Isabel was out of the operation for 10 days on maintenance. Finland, Sweden, here we see nice recovery from last year. So the main reason for the recovery is from last year is that last year the cruise ferry Baltic Princess was out on the dockings for 68 days. Other segment, most of the impact here is coming from hotels, as explained earlier. So one hotel less in operations, and also the impact from the renovations in Q1. And also slightly lower revenue from the land shops. On the next slide, we give you overview of the capex investments in Q1 2019. So the investments amounted to 25.3 million euros. Majority of the investments were made to the technical maintenances and renovations of the ships. So all in all, 7 ships were out in the dry dockings during the Q1. During the dry dockings, among the regular docking works, there were done also a number of renovations of the public areas. So, for example, on Baltic Queen and Galaxy, we rebuilt the Fast Lane restaurant from the very good feedback from Baltic Princess, which got the Fast Lane restaurant last year docking. And also the Grand Buffet and show bars were upgraded. On Silja Symphony, for example, we renovated the Starlight show bar to its new identity, and also refurbished some restaurants, Grill House, Bon Vivant, etc. And also Tommy Hilfiger shop-in-shop was built on Silja Symphony. In addition to the regular maintenance type of capex and renovations, we also invest into the energy efficiency solutions. So on the older ships, we upgrade the HVAC systems to gain more energy efficiency and fuel savings. Also, we continuously implement the fuel monitoring systems, and also to the shore power connections readiness in cooperation with ports where we operate. And in addition, we implement the hybrid battery solutions for smoother operations of vessels. probably the single largest investment this year and for coming years will be the new LNG shuttle ferry. The total investment will be approximately 250 million euros, and out of that 30% will be paid during the construction time and 70% at the delivery. So the construction will last almost 3 years, and we hope to get the delivery of the vessel early 2022 and start operations. The first part of the prepayment, 12.4 million euros, was made in the beginning of April to Rauma Marine Constructions, and the total capex from the new building in 2019 will amount to 25 million euros, and the rest will be paid until the construction. The arrangement of the financing is developing with a good pace, and we have competitive offers from our cooperation banks, and hopefully we conclude the financing contract soon. Here we present our income statement. So revenue slightly down from last year, and the EBITDA, which includes also the effect from the IFRS 16, is on comparable level, and the net profit is down from last year 5 million euros. The consolidated cash flow statement. So operating cash flow is on comparable level with last year. First quarter, the capital expenditure, as explained earlier, mostly to the technical renovations and upgrades to the public areas. And this year there will be total, in addition, close to 25 million euros capex made related to the new building of the vessel. So interest and other financial items slightly down from last year as expected, and that also includes here 0.6 million euros, the adoption effect from IFRS implementation. Balance sheet, total assets 1.6 billion euros. Also, there is a 101 million euro impact to the non-current assets, so the capitalized lease contracts. Out of the non-current assets, approximately 1.2 billion euros are the ships. So interest-bearing liabilities, when eliminating the effect from the IFRS 16 adoption, 104 million euros addition to the end of the quarter numbers. So it's slightly down, the lower number of interest-bearing liabilities compared to last year. Net debt to EBITDA stands at 3.9 times at the end of Q1. Net debt, again, impact from 104 million euros impact from the IFRS 16 adoption here stands at 557 million euros, and the equity asset ratio is very solid, 53% at the end of Q1. On the next slide, we explain in more details the IFRS 16 impact to the Tallink Group balance sheet. So the content of the impact is that the main rental contracts are related to the rent of the hotels, the offices, and logistics center, and some equipment. So the Tallink Group has decided to implement the IFRS 16 retrospectively from 1st of January 2019, and that means that we have not restated the 2019 numbers. So this is the provisions allowed by the standard, and this is what we have chosen to how to present this. So the adoption effects as at 1st of January 2019. So the addition to the fixed assets was 107 million euros. This is mainly to the buildings and premises. Addition to the interest-bearing liabilities in amount of 104 million euros. So adoption effect on the retained earnings, the difference in between these numbers, minus 3.6 million euros to the retained earnings equity. Also, we show here the effect, or for comparability purposes, the effect on the first quarter financials. The addition to the EBITDA is 4.2 million euros, so that's less rental cost in operating expenses. The addition to the depreciation after EBITDA then is 3.6 million euros, and addition to the interest cost after EBIT is 0.6 million euros. And on the net result, there is no effect from the adoption of IFRS 16. Distribution to shareholders. So in the published AGM agenda, there will be, among other proposals and agenda points, a proposal for dividend distribution. So the management board proposes to share a dividend 5 cents per share from last year's profit. In addition, for the purpose of improving the company's capital structure, there will be additional payment of share capital reductions, 7 cents per share. If decided, the dividend will be paid out in a regular space in early July, but the payment of the capital reduction according to the regulation of the Estonian Commercial Code will take approximately 6 months. But the ex-date will be same for the both decisions. That is shortly all from the presentation. We have received a number of questions.
Yes, thank you for the presentation. Now we will proceed with the questions in the order they were received. I would like to remind you that you can send in questions using the question box on the right side of your screen.
Okay, we have received a number of questions by email before the presentations. Okay, so let's start with the questions. So the questions are quite lengthy occasionally, so we have to reserve some time. The first question, on the adjusted EBITDA, excluding IFRS 16 effect, can you please quantify the level of extra cost from maintenance work not recorded as CapEx in Q1? The second bullet there, can you please quantify the size of the non-recurring items relating to the compensations paid to resigned management board members? And third point bullet on this question, adjusting for these costs, was the underlying EBITDA roughly flat year on year? A short answer to this is approximately yes. So the compensations paid to the resigned management board members, in combination with some of the OPEX type of works during the dockings, and also in addition during the dockings, a number of technical staff went for a vacation. So all these costs built up in a levels that we can say that the kind of eliminating the one-off effects from the Q1 result, we get to the comparable EBITDA. Second question. The question is about the guidance for the full year 2019 sales and profitability. So first question, can you discuss the sales outlook of the high season, June to August? Are the pre-bookings up or down year on year? First of all, we have to say we have not given out any guidance on these numbers. How we want to comment this is that after the dockings, long dockings and maintenance and renovation works, our fleet is in very good condition ahead of high season, and then of course we work very hard to improve the results and deliver. Second question, how confident are you that you will be able to increase sales in your core business, particularly taking into account the increased competition from competitor adding a ship? Obviously, there might be impact, although it's too early to quantify the impact, if any. Yeah, we can just make a reference to the last season addition by the competitors in 2017. The other competitors' numbers were largely affected. Some won the passenger numbers, some lose the passenger numbers, but Tallink had really limited effect on this. This time there is more focus on cargo competition, so the impact remains to be seen. Third question under this bullet, how do you expect your operational costs develop in 2019? Yes, we feel the cost pressure, and at the same time we are working hard to optimize the cost through different activities. So we have implemented the totally new procurement function. We have different energy efficiency saving initiatives through CapEx and operationally as well. We are using seasonal staff and also optimizing the use of staff on the ships as to have a proper number of staff at any time. Also, we have done a number of centralizations. So especially from support functions like central warehouse. Also, we have centralized support services, call center, accounting and finance functions, etc., etc. So lots of initiatives in-house, all not visible, but we think we are in good shape. Fourth question under the bullet. Is there a risk the full year 2019 EBIT is lower year on year? Well, again, not giving any guidance on the results. Just to repeat that after the maintenances and renovations, we see that we are in very good shape ahead of the high season, and we work hard for the good results. So last question from this set of questions.
So I will maybe take this one. Your long-term ambition is to increase profitability and increase shareholder value. What are the elements in your operation and the market that you expect to change in order to improve profitability? So we have set our strategy, and this is our long-term plan with the goal to increase profitability and the value for the investors as well. So we strive for the highest level of customer satisfaction. This means that we continuously upgrade the services that we offer on board and try to be better every day. We seek to increase volumes and strengthen the leading position on our home markets. And this we have done through upgrading our ships, building new ships that have more capacity and have are a good fit. All the vessels are tailor-made for the routes that we operate. So the third point in our strategy is to develop a wide range of quality services directed to different customers and pursue new growth opportunities. We also ensure cost-efficient operations, and we manage an optimal debt level that will allow sustainable dividends in the future as well. I hope this answers the question here. So we have another set of questions, and the first one is regarding the investor has said that our medium ticket price fell almost 4% in Q1. Could we elaborate a little bit about the competition landscape in our routes? But the competition has always been fierce, especially on our Tallinn-Helsinki, our main route. But about the ticket price, we use dynamic pricing, so the ticket price is really affected by this, and it's really a offer and demand question. But we are the premium product on the market. We invest the most, and so our ticket prices are competitive. There is a question on the fuel prices being quite volatile in Q1, and how did this affect our result? Well, although the fuel prices were higher, we used a little bit less fuel because of the less trips. We have the fuel hedge in place from December, so not all the higher fuel costs was passed on to us instantly, and we have this hedge in for the 2019 whole financial year. But altogether, the fuel prices were higher, and so the our fuel price obviously is affected by this. And there is the next question is: there is increasing competition showing in your Estonia-Finland route, especially in cargo. How do you see Eckerö Line's new ship on Estonia-Finland route going to affect your volumes? Well, first of all, we also have a cargo vessel on the Muuga-Vuosaari route. And our strategy has been that the Tallinn-Helsinki route, as it connects the city center to city center, should be a environmental friendly and green route. We have invested heavily. We have introduced the first LNG vessel, and now we are constructing the second LNG vessel for this route. And we have tried to direct away with Seawind the cargo, so that the city centers would be less heavily affected by cargo traffic. But obviously, if the competitor brings a cargo vessel here, we have to evaluate the situation, the market situation, and there is a possibility that we also bring then the additional cargo vessel here.
Okay, next set of questions. First question: number of trips decreased by 1.5% in Q1 due to dockings, but passenger number decreased by 3.9%. Please elaborate what explains the difference. Different items that can impact this, but one of the items is, of course, that as mentioned earlier, for example, the Estonia-Finland total market decreased by 4%, and then the our volume there decreased by 3%. So different impact from different segments. What are your expectations for passenger volume development going forward as stockings are now behind? That question was answered earlier, so we will not give any guidance, and then we are in good shape ahead of high season. Please explain the key drivers behind different cost line developments, cost of goods sold, sales, marketing, admin. We usually don't go into so detailed levels, but of course, again, referring to our internal work on different optimization activities, we do believe these are well under control and more efficiencies to gain. Will sales, and another question, will sales and marketing and admin cost levels increase in 2019? Again, of course, we are living in moderate inflation kind of economic environment. There is always inflation expected into the costs, but again, we work hard to optimize costs and have cost-efficient operations. Next question, will your fuel bill increase or decrease in 2019 versus 2018? Well, nobody knows that really. Good question. But on the Q1 numbers, as Harri explained, the market prices are up, but our impact to our fuel price is the price increase is very limited due to the well-positioned price fixing before the beginning of the year. And also, as mentioned in Q1, we have less trips, so actually there were in total number savings as there were less trips. CapEx level in 2019, next question. Explained earlier, so far 25 million invested to maintenances and renovations. Additional 25 million will be prepaid for the new building, so 50 plus million euros, rough guidance on this one.
So we have this is all with the questions that were sent before the webinar, and now we are taking a look at the questions sent during the webinar. So maybe we quickly go over, but some are already answered. So passenger volume expectation for the remaining of the year. We do not give out guidance, but obviously we will do our best to have a high number of passengers during the 3 next quarters of the 2019 financial year. Could you please quantify the one-offs booked in this quarter, also compared to the last year, and what was the impact from fixing the fuel?
Okay, I take this. So the one-offs were explained earlier. So very roughly, if we're considering the one-offs, the EBITDA would be flat year on year. The impact from fuel fixing, again, explained a couple of questions earlier. So in Q1, there was an increase of the world market prices. The price increase passed to our input prices is very limited due to the price fixing, and in Q1, as the total volumes were smaller compared to last year, the total fuel cost is slightly down.
So the next question is, how much was the one-off compensation to past management? Unfortunately, we do not disclose this data.
Next question, same.
How the total fuel cost changed in Q1 compared to Q1 last year?
So this was also mentioned that despite the world market prices increases, the total fuel bill for Q1 is slightly lower compared to last year, and that is mostly due from the dockings and lower number of trips.
So there is a longer question here. The report attributes poor PAX traffic of Estonia, Sweden to dockings of Baltic Queen and Victoria. Was it the only reason behind the fall in PAX? If so, do you not experience increased competition from attractively priced air travel offered by several airlines on Tallinn-Stockholm route? We compete for the people's free time. So air traffic is only one of the competitors, but generally the Swedish market has been doing well, and there is interest to travel with our vessels, and then this PAX traffic was directly affected by the lesser amount of trips.
Yeah, also here I can make a reference. I don't have exact statistics for the Estonia-Sweden air traffic, but make a reference to Estonia-Finland. Total passenger numbers going in between Estonia and Finland is roughly 10 million passengers, and only 2% of that is served by the airlines. So yes, airlines are kind of indirect competitor for us, but we have rather different product offering. We are serving the passengers with cars, we are serving cargo, we are serving the overnight cruise, city cruise, travelers, etc. So probably not that kind of direct impact from the competition there.
So the next question is, what is the expected financing cost for the new vessel given rather high leverage and changed dividend policy? I'm not sure if I understand the question right, but the rather high leverage, we have said that our comfort zone in the leverage is 3 to 5 times the EBITDA, net debt to EBITDA, and we are right now at 3.9, so we don't consider this high position. The financing cost is, we have export credit financing, and this is tied to the CIR.
Yeah, for the Megastar, for the new vessel, I mean the prepayments for the new vessel will be made over the timeline of 3 years. So that is already quite long time, and the last part of the investment will be taken on and financed with the long-term bank loan. So during that 3 years, we are still regularly paying down our debt. So depending on the years, historically 60 to 80 million euros. So we believe that Tallink Group financial position is continuously strong, and I wouldn't say the company is very highly leveraged at the moment. So the capital equity, capital ratio is currently at 53%, which is actually quite high for a company as Tallink. So I hope that answers your question. Question, why there appeared a difference between initial right of use asset and lease liability? Don't really get the question. I mean, that is the change of the IFRS standard, and that is mandatory to implement, and there are specific guidelines for the implementation, and that we have disclosed in the presentation earlier.
Do you see any measures being taken on the institutional level to bolster Finnish traffic, and do you take any measures yourself to boost traffic on the Tallinn-Helsinki route? Well, there are many components to the Tallinn-Helsinki route why people travel, and in the last years we understand Tallinn has become a more expensive city for the Finnish traveler, and this is also a little bit explained by the higher excise tax by the government. So we hope there will be change there, but as a ship operator, we are continuously offering a good product and are promoting it. So we do hope to see a higher level of travelers, but our strategy on the core level remains the same.
So additional question on the compensations to the management. We will not go into details on this one. Question, why are there too many changes in senior management team in Tallink? Is that the reason for the weak performance in Q1? First of all, the changes were happened already. Changes happened already in Q1, so the changes were initiated earlier, and the first major change was onboarding of our CEO, Paavo Nõgene, last May, and of course every CEO will form its own team. And now we have been through with all the changes in the management team, and I think we are in a very good position and very strong skills and know-how set on the management level.
True, and this question should be directed directly to Paavo, and I believe the next opportunity is on the 23rd of May on the annual general meeting as well.
What do you see as the main reason for traveling on Sweden-Finland route by your customer? How would you assess this traffic in terms of cyclicality and sensitivity to macroeconomic conditions? Very good question. So if we're talking about Sweden-Finland, then we have there two routes, Helsinki-Stockholm and Turku-Stockholm. Slightly different by its operations type and maybe also passenger type. So the Helsinki-Stockholm, that's overnight route, and mostly there we see leisure travelers, so going for a city break from either side, and also lots of families there. There are very nice kids areas. So this is very appreciated and well-working service for our customers. On Turku, there is like 22-hour cruise, and then there is also possibility to take this Saaristo cruise, to switch over on Mariehamn. So again, slightly different vessels and more intense operations, more cost-heavier operations. But still, the encatchment area for Turku-Stockholm is rather different. The Turku, the west coast area of Finland, and as numbers presented earlier, the recovery of the market from last year, very long 60 days docking of the Baltic Princess, happened rather quick, and the route shows very nice numbers currently. The planned distribution amount to approximately 88 million euros. Do you use some financing agreement ready to cover the full amount? Well, I would make a reference here to the quite low leverage of the company right now, and also make a reference from where we come to that position. So the company's cash position has been, let's say, above normal levels since end of 2017, when the company sold 2 superfast vessels that were earlier chartered out, so for more than 130 million euros. So to a large extent, some of the older debt was repaid with this, but to a large extent, the cash has stayed in our balance sheet. So most of all, the large distributions that hopefully will be decided this year will be paid from the existing cash position, and our financial position as the equity ratio currently stands at, and to mention this is the peak of the low season, the equity ratio stands at 53%. So we see that we are in very good position either way to add additional loan into our financing portfolio or look for any other financing measures. So this is just regular dealing for us. So lengthy questions, so just give us a minute, please. There is a question with regards to the EBITDA comparability. So let's go into the numbers presented in the report. So just to be absolutely sure, the 2018 Q1 EBITDA was 4.2 million euros, and last year Q1 EBITDA does not include any effect from IFRS adoption. The Q1 19 official reported EBITDA is 3.8 million euros, but that includes 4.2 million IFRS impact. So the like-for-like numbers are last year Q1 EBITDA 4.2 million euros, and the IFRS 16 adoption effect adjusted EBITDA minus 0.4 million. And all these numbers are brought in detail on the quarterly report, page 7. I hope that clarified that question. Next question, how big was the growth in average salary in Q1 year on year? We don't disclose such detailed information, unfortunately. Next question, do your banks count for the new lease liability when calculating lending covenants? I believe the impact to the covenants, namely leverage related, and then, for example, net debt to EBITDA ratio, there is very minimal impact, and we are very safely within these covenants currently, also considering the standard adoption effect. Having said that, I would assume that the bank contracts did not anticipate the change of the accounting standard, which has impact to the underlying numbers benchmarked against the covenants. So I would assume that the banks, for the legal reasons, need to refer to the official numbers that will include the IFRS 16 effect. Next question. Follow up on this Estonia-Sweden PAX question. Impact from lower PAX that we saw on operating profit suggests a decline in operating leverage, i.e. lower capacity utilization on ships, which in turn suggests that the decline in PAX on the route cannot be fully explained by dockings. Do you agree? That would be more detailed analysis, which unfortunately we don't have time here to dive in. Sorry for that. Next question. How many hotels do you still have in your portfolio, and any plan to sell any more of them? First of all, we don't own any hotel properties. Tallink Group is only the operator. We have currently 3 hotels in Tallinn and 1 hotel in Riga. And again, we are only operators of the hotels. This offering accommodation possibility for our passengers, that's really supporting, enabling us to sell travel packages and more convenient travel service for our customers. So currently we are satisfied with the current set of services and number of hotels we have. Follow-up question on adjusted EBITDA. Question. Whether the adjusted EBITDA includes both one-offs, meaning that the one-offs we brought out were related to the compensations to the resigned management board members and IFRS 16 effect. As the footnote on the report, page 7, says, the comparable EBITDA for Q1 2019 without IFRS 16 adoption effect. So the adjusted EBITDA on this level, only the IFRS 16 impact is eliminated from this.
Okay, this seems to be all of the questions. I hope the answers were helpful.
Yes, it seems that all the questions have been answered. And if you don't have any more questions, then I would like to thank Harri and Veiko for the presentation and answers. And I would also like to remind all the listeners that the summary of the webinar, together with the presentation, a link to the recording, will be made available in today's investor event announcement from Tallink. Again, thank you, Harri and Veiko, for your time. And thank you, participants, for joining the webinar.
Thank you from our side.
Thank you very much.